Greetings, everyone. I think we'll get underway. My name is Rochelle Blees, and I want to welcome you to the webinar today, Beyond the Filing Surge, where bankruptcy risk is concentrating today. We have a lot of content to cover, and I'm joined by two amazing experts. So without further ado, we will get underway. But of course, we have disclaimers and housekeeping matters that I'll cover first. Not intending to read this, but essentially says that we're not here to provide any sort of legal advice. This is really for your benefit. And so kind of typical disclaimer. Now I'll move into just a couple quick housekeeping matters. You can submit questions today via the questions panel within the GoToWebinar application. You can also email questions you have to marketing@g2risksolutions.com. We are going to try to have some time at the end of the program for questions, and we are recording this session, and we will make that recording available to those who have registered for the webinar at the URL that's indicated below. So without further ado, I want to give a little bit more detailed introduction of our panelists today. We are very pleased to be joined by Hilary Boniel. Hilary is the managing director of Boniel and Associates. That firm is a default services firm based in Dallas. Hilary was born and raised in Louisiana, and now is the leader of the Boniel law firm, which bears her name. And she has really been quite a leader in this industry for over 35 years, and representing creditors. She is a frequent speaker, and if you know Hilary, you know how much she loves bankruptcy law, and she's a regular attendant at a lot of industry events. She and I are kindred spirits in our love for both boating and barbecue. Just a little factoid about Hilary. But she's also been a leader in many other respects, not only with respect to Boniel and Associates, but that firm is certified as a diverse firm and an LGBT-owned business. So thank you, Hilary, for joining us today. Our second panelist is Ryan Sanders. Ryan is the Vice President of Enterprise Sales with G2 Risk Solutions. He has more than 25 years of experience working with banks, lenders, servicers, and other constituencies within this whole bankruptcy ecosystem. His expertise through over the years has been developed around making bankruptcy operations more efficient through data, automation, and workflow. Those are some of the topics that we want to get his insight on today. He's an author and regular speaker on bankruptcy trends and how those trends can be embraced and made more efficient through workflow modernization and other strategies to be more efficient. And so I welcome both of you as panelists today, and I will be your moderator. I am the president of G2 Risk Solutions, very proud to have held that position for a few years, but roughly 40 years or so in the fintech, regtech space. But that is just by way of background as a moderator, because I cannot hold a candle to these two experts that we have with us today. Let me walk through at a very, very high level the proposed agenda, and we'll be following this today. We're going to talk about the filing trends and what some of that might mean in terms of shifts and implications. What are the things that are driving that increase, and why should we pay attention to some of these signals? These increases are also going to be hitting operational workflow and systems. And so we're going to talk a little bit about how these rising volumes are going to impact the operational aspects of bankruptcy risk management. Hilary is going to help us better understand the implications of Rule 3002.1 and what that means in terms of things that these listeners can do to address some of these changes, some of the trends, and really operationalize some of this in their own enterprises. So that's the agenda for today. And again, I want to invite questions through the application, and we'll try to reserve some time at the end. So if we can sort of move into some of the substantive data here, we have seen filings continue to trend higher throughout 2006. And I don't think the story is really about any particular month per se, but more the consistent growth. And we're going to talk about the implications of that. But what I want to do, and let's go to you first, Hillary.
Sure.
What are you seeing in the market today, and what stands out most about the current trends and the implications to the bankruptcy environment?
Well, what we're seeing today is a pretty steady growth in bankruptcy filings. We're seeing, I know that the information we're looking at a national trend of a growth of about 10% every year in the filings that we see. We're seeing that growth month by month. We're seeing, but we're not seeing spikes, right? We're not seeing a certain area jump up. The South is always strong in bankruptcy, and it remains so. But it is not an outlier. It is not alone. We're seeing consistent growth at a steady pace. We're just now, I think, coming close to pre-COVID numbers of filings, which, depending upon who you listened to during COVID, it was either going to be a tsunami or it was going to be a slow walk up a tall hill. And it looks like we're taking a slow walk up a tall hill, but we are getting there. So internally, for me and my clients, it depends on what their collateral is as to their growth. We're seeing figures from 8% for some prime lenders that we represent, up to 17% growth for the subprime lenders, which isn't out of the ordinary at all. That's what you'd expect to see when you have a national level of growth of about 10% year over year.
Yep.
Ryan, any thoughts?
No. So a lot of the same, it's the steady growth. There isn't really one thing, like a big spike. We still see the normal seasonality changes. You'll have your larger months, you have your lower months, but we compare, year over year, each one of those months is now exponentially more than it was from the prior year. So that's, again, it's that steady growth that Hillary touched on, from, the broader consumer, data, the news, everything that we kind of see coming at us, really just ties into a lot what's driving, where we're seeing the consumers, starting to feel that pressure and file for bankruptcy. So
I think there are a number of different drivers. If we want to talk about them in a bit more detail, it's hard to listen to the news or read the news without hearing about the borrowing costs and other drivers of this stress, whether it's inflation or just increased debt regularly. Also labor softness as a contributor. And Hillary, let's again go to you first. Are there particular segments, whether it's regional segment or some other demographic, where you're seeing this pressure that is either greater or more stressful?
Well, historically, foreclosures have driven bankruptcy. And as the foreclosure numbers rise, so does the number of bankruptcies. And that makes sense, right? The bankruptcy can allow somebody to stop and hopefully become current on the house, which is everybody's major, the largest asset in there. But we're also seeing it come from other areas. And what's um, pushed us coming directly out of COVID initially was the car creditors. The car creditors were one of the first ones out there. They got nice and aggressive and started to recover on those things. Um, and that pushed some bankruptcy filings. But now that all of well, I'm not going to say all, but there was a very robust um, section out there of loss mitigation that was able to be offered to homeowners, loan modifications, partial claims, um, the half funds that came out that allowed people to become current on their home where maybe they had an interruption in income during COVID and they were able to modify the loan, become current, push things to the end. It gave them a bit of breathing room. A lot of those programs and offerings have now run their course. There's not as many of them. They're still available, but there's not as many of them as before. And so we're beginning to see the loan modifications that maybe weren't as good as everybody had hoped they were going to be coming into foreclosure now, and that usually pushes things. Um, and as as the other lenders remain aggressive, including the credit card lenders, we're seeing more collection activity by the credit card lenders, and that always pushes towards people towards bankruptcy. The more collection efforts overall that are laid out, that are put to pressure the borrowers, the more bankruptcies we're going to see. So,
Ryan, any comments on these drivers from your perspective?
Yeah, some of you might have heard me talk about this before, but during the pandemic, there was a lot of resources, right? Hillary touched on. In addition to you're getting stimulus money, you saw a lot of people, either paying up on an existing loan or, paying down their mortgage or paying down their car, putting money in savings. But as you were coming out of that, I think spending habits continued. Obviously through you see the credit cards reporting, the number of, volume of credit card debt, and then the increased and delinquencies. So with all that kind of that those savings eroding and the increased spending, the inflation, a lot of these things compiled, is really kind of where I feel that pressure is coming from, where the bankruptcies are increasing. So.
Well, I want to talk a little bit about the mix that we're seeing in the data, the mix between the volume and growth in Chapter 13 filings versus Chapter 7 filings. And again, you've both mentioned this in your comments. There's not really any spike, rather it's more a story of consistency. You've both also mentioned contrasting and comparing this data with pre-COVID. And Hillary, again, let's start with you. What do you think the differences that we're seeing, differences between this recent data and sort of pre-COVID data? What do we think those differences may mean? What are the implications for lenders, for servicers, for debt collectors?
well, what we're seeing and what we initially saw was the rise in bankruptcy is a lot of Chapter 7s. The Chapter 7, the difference between the Chapter 7 and the Chapter 13, for purposes of this. A Chapter 7 gets rid of your unsecured debts. A Chapter 13 allows you to become current on your house. And so when those economic pressures that we discussed previously were there from the credit cards and the cars, and when people experience job loss or they experience underemployment, oftentimes that goes with an interruption in their health insurance. So let's lump hospital bills and medical bills in there. Chapter 7 tends to be the way that people go when they don't have a large asset like a house to protect. So the rise in Chapter 7s makes sense, right? Because the programs were there to protect the houses. So if we were protecting a house, we didn't need to go necessarily into bankruptcy to do that. Well, now that those programs have gone, we are seeing a steady rise in Chapter 13s, but as normal, the Chapter 7s outpace them. And you will see more of a, let's call it a seasonality spike in the Chapter 7s. You tend to see more Chapter 7s after the tax refunds have dried up or been used. And then as we go forward, it tends to balance out the mix a little bit. But pre-COVID, it was always a 70-30 split between Chapter 7s and Chapter 13s. Post-COVID, we're seeing closer to a 60-40 split, but it's normalizing. The further we get away from the pandemic, the more it is normalizing back to the pre-COVID splits that we're used to seeing.
Ryan?
Yeah, Hillary, the one thing I'd heard, and it'd be great to have your feedback on this too, is just around 13s and specifically in mortgage. At one point, people had this, this buffer to work with, right? A ton of equity in their homes, and they're able to kind of, get out from there. They could refi, they could do something to ensure that they're able to, keep those assets, right? So you'd have a lot of foreclosure starts, but maybe not a lot of foreclosure finishes. And I think near the end of the 2025, I started hearing that a lot of those starts were now going to,
Yes.
to completion. So, again, it's, as those reserves kind of dry up, and they want to hold on the homes, the expectation is that you're probably going to see a lot more 13s. So
yeah, that's absolutely true. The rise in home values for many people now has been eaten up by the rise in insurance costs, the rise in taxes, and as you know, once you get behind one payment, two payments on the house, it snowballs. It truly snowballs. And while there was equity, and there might still be some limited amount of equity there, it is getting eaten up. And it's getting eaten up quickly. And that's what we're seeing in these figures is the non-bankruptcy means of getting out of that are becoming limited again. And so bankruptcy is, I'm a supporter of it. I like it. Bankruptcy is a way to allow people to take actions to save that asset, to save that house. And so that's why Chapter 13s are coming back again.
Well, let's move in. I think a more operational direction on some of this data. And, I think a lot of listeners on this webinar are creditors, servicers, debt collectors, and there are absolutely operational implications to these increases. And maybe I'll start with you, Ryan, just broadly. When and as we're seeing these filings increase, where do these organizations tend to feel that impact first from an operational perspective? Maybe walk us through that. And then Hillary, if you could comment, and then I think we're walking towards, I think, the implications of Rule 3002.1. So I'd like you, maybe after Ryan, just to take us down that pathway a bit, if you would.
Sure.
Yeah. So, I think it really starts with the intake process. When volumes are lower, a process isn't necessary, and the process doesn't necessarily give you a single source of truth. It's manageable. But as volumes are increasing, 5 to 10 more bankruptcies, there's going to be 5 to 10, maybe 20 more things for each one of those cases that you're going to have to do. So exponentially, it's going to be building up that stress on an organization, right? And again, from our perspective, having that single source of truth helps mitigate a lot of those extra steps, a lot of the extra validations that may have to occur in a process that is traditionally more manual. So again, it can quickly add up, that 5 to 10 extra bank cases. Now you're looking at 2 to 3 more things for each one of those that you're getting, and that scale starts to expose some of those inefficiencies. And again, I think, as Hillary, you're going to touch on, specifically around 3002.1, some of those impacts and how that's, affecting operations, those 5 to 10 more, plus the 5 to 10 more other things that you got to worry about for each one of those cases now. So it's just the burden that's going to create on an ops they're going to start feeling more. They are starting to feel it more, especially coming out of the COVID. You may have had less people. It was manageable, right? It was way manageable at the volumes, but with this increase, it's everyone's starting to feel that pain. At least that's what I'm hearing. So
Yeah, absolutely. We're seeing the same things. A lot of the, pardon me, a lot of the bankruptcy operations for our clients had skinnied down greatly, and they had, they've got their best and brightest is what they have there. And the best and brightest can handle a lot of unusual things coming at them at once. But as the volume has grown, we've watched our clients and some of our operations. Okay, now the volume is such that we need to start hiring again, and we need to start training again, and that puts more pressure on the ability to keep up with the things that are happening, both new cases coming in, like you said, another 5 to 10 a day makes a huge difference in an operation. Something that used to be able to, I could just get Janet to work another 20 minutes and we'll be fine. Well, that's not true anymore. The volume is such that now you're having to add bodies, and these bodies need to be brought up to speed on your processes and procedures, brought up to speed on the training. And that is something that takes time and energy from your top performers and your training folks to do. We also saw that, during the low part in the bankruptcy filings, during the COVID era, because there wasn't a lot of volume coming in, a lot of the resources, the technology resources and things like that inside our clients were shifted to other areas, and rightfully so. But now that these things are coming back, the requests for those resources, are coming up again, and they're limited by their nature. They're limited resources. Then we've got now the addition of the revised rules of 3002.1. As we move into looking at that, that rule came into effect. So it is in effect now, December 1st, 2025. And one of the largest implications of it is that it is effective and needs to be followed on cases that were already filed. So what we've done is we've taken a population that has been growing, and then we've added to it the amount of interaction, review, and work that's required for each individual case. So the ideas of what can work per, how many files per person, per head count, those things. You need to go back and take a look at those, because what we're asking people to the number of things we're asking people to pay attention to, the number of cases we're asking people to touch on a regular basis has gone up. The modifications and updates to 3002.1 were meant to cause more work, both for us on the creditor side, for the trustees, and for the debtors. It was designed to expand its scope. So previously, the prior iteration of 3002.1, applied to the debtor's principal residence as it does today. Now, that principal residence doesn't just mean a house on land. It can be a condominium, a mobile home, a travel trailer, whatever somebody is using for a principal residence. In addition, they have modified or taken out the reference to contractual and installment payments. Now, the implication of that is that now it applies to things like reverse mortgages, which historically we could argue were not covered by that rule, but now it is. So that brings a whole nother group of loans in that are going to be covered by this stuff. They the drafters of the rule and the rules committee and all that stuff did try to help us a little bit. They did try to help us by having having forms for us. So the filings by the debtors and the trustees are forms. Our filings as creditors are forms. But as you know, anytime you deal with federal forms, they're not as easy as they look. So we're having to, we went through a very long process of getting those documents in, working with our clients to define what data points are put into those. So they're out there, and they need to be utilized. They're required to be utilized by the rule. So know that they are available. I can give them to you if you need, but that is what's required to be done there. And then we have some new things that, historically in the rule weren't there. So we have new instances that we have to keep our eye out for and to deal with. And one of those instances is the end of case sequence. So if we can, let's take a look at the end of case sequence. Historically, only about 40% of the trustees or cases nationwide took advantage of the end of case sequence, or the end of the bankruptcy case sequence, let's call it, that was available under the old rule. The drafters of this new rule, of new 3002.1, thought, well, we need to make people work harder, at the end of case. We want to make sure that there's some actions being taken, that people are engaged and get answers to questions at the end of case to give effect to that fresh start. So one of the changes that they made is breaking up the notice of final cure at the end. For those of you who have dealt with these in real property, the notice of final cure was not a consistent process amongst trustees or debtors. And we just kind of went by the seat of our pants and responded when we got stuff. But for the most part, many trustees weren't participating. And when they did participate, we didn't get answers at the end. So now the drafters have taken a look at it and broken it up into two phases. Okay, that's one of the important parts. We've got two phases here. The first phase is the trustee filing a notice of disbursements made. Now, whether the trustee dispersed on arrears and on the post-petition payments, they still have to file something in at the end of the case saying, I sent out this much money. You got this much money, right? And the creditors are required to respond. Now, I'm going to hit this a couple of times. The creditors are required to respond. They have to come in and say, yes, You sent out $500, I got $500. If, on the other hand, the trustee says they sent out $500 and you only got 400, then you need to respond that you didn't. But either way, the requirement is that you respond. If you disagree with what the trustee sent out, they said they sent out 500, you only got 400, then that requires a court hearing to determine what the truth is for that particular case. In the prior rule, we'd file a response and people just stare at each other. You know, we never got an answer. The way the rule's written now, it's forcing an answer. So once we get the answer as to what the trustee dispersed, then there's an opportunity. It's not a requirement, it's an opportunity for either the trustee or the debtor to file a motion to determine final cure. So what we've done is we've taken a process that about 40% of the trustees participated in. So 40% of the cases you'd have to touch at the end. And we've expanded that to everything that the trustee disperses on. So we've added 60% to your workload. And then we've taken and added the second part that might come on to it. So again, when you're looking at your staffing for the end of case run, you need to take into account that they're going to be handling significantly more work per person than they were before. Okay. You can't depend on those numbers because the rules have changed. So now, after the trustee files their motion or notice of disbursements made, now we have a motion to determine final cure. That is intended to define for the debtor, the creditor, and everybody else whether or not that loan is contractually current when it comes out of bankruptcy. That includes the pre-petition arrears, the post-petition payments, any fees or costs that might have been incurred and noticed to the court during the term of the bankruptcy. So it is an important process because it gives us an answer. Are they current? Yes or no. Now, answers are rarely that simple. And the amount of work and the amount of effort that it takes to respond to these is significant. But it does give us an answer at the end of the case, and that has value. So let's take a look on how we're doing. I mentioned before that prior rule, not all of the trustees were filing these. But now we could take a look and we're seeing more trustees than before filing these. We don't yet have everybody on board, right? But we've got a number of them that were not participating. They are now participating. So, at the time that I took a look back, we were, a couple of months, 3-4 months post the rule coming into effect. So after December 1st, 2025. And we are seeing the volume of things that creditors have to find, analyze, and respond to, that is growing. That has definitely gone up. We have more folks responding than before, which is also good. But we don't yet have, people aren't taking full advantage of the rule. So while we do have many trustees participating in this process, we don't yet have all. It's not clear whether they're just a little slow on the uptake or if they believe that, it doesn't currently apply to them, which it does. But, opinions differ. And we don't yet have a lot of court rulings saying whether or not our interpretation of the plain language of the rule is how the courts are going to interpret it. So we've seen a lot of notices of disbursement. We've seen very, very few notices or motion to determine final cure. And that's kind of surprising, considering what we all thought, looking at this rule coming into effect, the value that it was going to present, we figured we'd see a lot more, and we're really not. Um, so we tried to figure out why, but as of today, we're not quite sure. So let's talk about see how the creditors are complying with this new rule, because you're my people, so I need to make sure that we're all doing what we need to do when these notices get filed. So are we? How is our compliance on this? What we're seeing is that not everybody, not all of the creditors are responding. So of the 383 notices that got sent out, not all of them got a response. We still have about 26% where the creditors are not responding at all. That's not good. Um, for the ones that did respond, we're not seeing necessarily all the time complete responses. Now, there's probably a reason for that. The amount of analysis that it takes to respond correctly and pursuant to the rule, which means providing a payment history, a bankruptcy compliant payment history, after 5 years of a case, that is a significant amount of work and effort for clients to take on and provide. And so I think that's having an impact. We're seeing a lot of responses, but some of those responses aren't complete. And I think it's because of the amount of effort and energy that it takes to put together all of the information necessary to fully respond. So the the problem here is the implication of not responding. One of the changes to the rules was that not only if you fail to respond, you can't come back and provide any evidence as to what the response would have been. So the trustee or the debtor comes in and says, I'm current. Your information shows that they're $500 delinquent, but you didn't file a response. Because you didn't file a response, you're going to be barred from presenting any evidence that shows that they're $500 delinquent. Essentially, that $500 goes away. Now, that's on a single loan, and those are painful. We don't want those to happen. We don't want you to get caught in those. But the bigger implication is this: a failure to respond can now result in sanctions, not just a bar to presenting information, but sanctions by the court for the failure to respond, which means that to the extent a jurisdiction or even a single judge finds or sees a systemic failure to respond or a failure to completely respond on these, the implications can be meaningful because it could span across multiple loans. It could span across an entire section of your operation, and we don't want to see that. So the importance of being able to find these filings on the docket. It's the end of case. Everybody's tired. There's always a lot of information that has come in already. Um, it's not the active, exciting area at the front of a bankruptcy filing where we're looking to file proofs of claims and things like that. This is at the end. Things tend to have gotten pretty quiet, particularly if they've made it this far. And now all of a sudden we have a spike of activity. We have a spike of activity that requires us to look back over those 5 years of bankruptcy payments that don't match your contractual system. And you have to put it in some kind of order. That's a lot of effort. We know that. And we're here to help. But it still requires you got to find it, you got to figure it out, and you got to respond. So we don't also have a lot of clear answers on how is this jurisdiction going to define current. I've had arguments with that. Does that mean that we are now, let's say that it's September 2nd, the payment was due on September 1st. If I don't have a payment, um, are they current? We're in September 2nd. It was due on the 1st. Is it current? We don't yet know that, because we haven't had enough go in front of the judges to give us answers. So what we're left with is each client needs to take a look at these. So take a look at it within your organization. Decide how you're going to respond based on the information that's available to you and a walkthrough with your in-house counsel or your bankruptcy counsel. Make sure that you have a reason for each of the calculations that you're doing to put those numbers on there. Doing your best is better than doing nothing at all. So, number one, you got to find them. So, participate, participate, participate. Number two, do the best you can. Since we don't have hard answers to give you, the thought process that you've put together as to how you're answering them matters. Okay. And number three is you've got to have the capacity to work these. As we see from the lack of complete responses, I think some folks were taken by surprise as to the volume that was coming in and the amount of difficulty it was. So, folks are working on beefing up those areas and beefing up their processes, finding more efficient ways to work through this, which is important. Put some thought to it because the failure to comply is significant. Sorry.
Well, thanks, Hillary. In a seemingly ominous hill. However, Ron, I'd like you to really comment on what should organizations be evaluating now as we see there's ambiguity amongst new rules, amongst higher volumes in filings. What should folks be thinking about from an operational perspective?
Yeah. I touched a little bit on this, I think, at the beginning, but do you have, that single source of truth to work through? Do you have a way to best consume that data efficiently to ensure teams, with the current headcount that you have, are you able to manage, all that additional workload? What technologies are you using? If there's ways to automate, based on the data that you're getting, there's, I believe, a lot they should be looking at as these things increase. And, just really thinking about, Hillary, what you touched on, and specifically, what that traffic that can cause, and, mentioning how you don't have complete participation by the trustees. And, once that participation really increases, how are you going to handle that? What data, are you going to, what technology you're going to use to kind of best consume and ensure that you're responding timely? It's, again, there's that ominous thing. And if everyone embraces it, what is that downstream impact going to look like? And, depending on, how many bankruptcies are being filed within that trustee's jurisdiction or region, if you have these lower participation or lower case filing trustees and they're sitting, and now you get the really high volume ones now all embracing it, I think it's going to hit operations, pretty hard. So, what are you doing to prepare for that influx? So, but yeah.
Well, part of the preparation, I imagine, is just looking at information that's available to help take this planful approach that you're both talking about. So maybe, Hillary, first to you and then to Ryan, what are the 2 or 3 things that you're going to be watching more closely between now and, say, year end to help in taking that thoughtful, planful approach?
Right. Well, one of the things that we look at and you guys help us with is the consumption of data on both the filings and the trustee participation to know when they start, where we're seeing the filings coming from, so that we can glean from that where we need to to expand our capabilities, where we need to take a look at adding or finding better tools, better ways to work things. It's, every organization does it. Everybody's optimizing all the time, and this is no exception. But having the information to know where my best bang for the buck is something that is vitally important. I'm also trying to keep an eye on things like the prime rate, the housing rate, the housing interest rate, and the softening of the employment market, because those three things I think contribute greatly to the number of filings. As interest rates rise, more people file. As it's more and more difficult to get into a house because the interest rates are high on the mortgages, the more likely it is that people are going to use every possible means to stay in the house they're in. And the more likely it is that people that are getting into new houses are stretched further than before.
Yeah.
And then the employment rate. Historically, medical debt has been one of the things that tends to be the starting point to push people into financial crisis 2-3 years down the road. If you take a hard look at them, about 2 to 3 years before they filed bankruptcy, there was a medical event. There was medical bills that came in and started the push of the pebble that turns into the boulder that crushes their finances. So those are the things that I try to keep an eye on.
Ryan, any additional data points that you're thinking would be helpful to monitor?
Yeah, I mean, we've seen the return of student loans, right? They're having to pay back student loans. That being the year, there's just these additional things that I think keep stacking on as pressures. That you have these people who had phenomenal interest rates, right? And they're no longer complaining about their mortgage payment. It's just everything else around them that is increasing. So, even the people who have the great interest rates are now having to pay more for insurance, utilities, you're always hearing things that everything's costing more, right? So all these things compiled is really kind of what I'm looking at. Every one of these new news items just feeds into what I think is driving a lot of the growth in bankruptcy filings. So,
Yeah.
but yeah, it's a lot of what similar Hillary touched on, plus some of these other things. So I got this nice little Amazon device that pops up news feeds, and every time I see something, I'm like, well, there's one more thing to kind of keep an eye on. So
Yeah. Well, I know we're a bit short on time, but I want to, I think, tried to summarize a few things, and we did get some questions submitted, and I'd like to cover at least one of them. And maybe I'd like first Hillary and then you, Ryan, maybe to augment these summary points. Filings, it's a signal, but there is a much more robust story about what's going on economically, socially, politically, and it all sort of mixes together in terms of drivers of the increases that we're seeing. It's concentrating in certain areas, and we need to pay attention to where it's concentrating and what we do about it. And notwithstanding some ambiguity in new rules, we do need to be ready. We do need to participate and think about the preparedness and downstream operational implications for our organization. So I think with that summary, Hillary, Ryan, anything to add to that, and then we'll go into a question.
The we've been discussing it the whole time. It's the pressure, right? we're seeing, particularly lately, more and more pressure being put on the middle class, and tends to be the middle class has assets they want to protect. Um, they want to protect their house. They need to have their car. Um, we're not necessarily, the implications of financial instability on the lower income folks is well known, but putting this much pressure on the middle class is something that I think we're going to continue to see the implications of until there's a pressure release valve somewhere. So that's something that is concerning to me, and I think is going to be a driver of the filings, at least in the short term.
Thank you. Brian?
Yeah, it's kind of tough. Again, to Hillary's point, you really covered a lot of this. What I would say, just not really seeing anything saying that, hey, it's going to get better at this point. So I don't want to be doom and gloom person for sure, but there's like one more thing that you're reading that, well, here's another thing, but I'm not seeing anything says, oh, there's going to light at the tunnel, things are going to get better. Consumer spending hasn't slowed down, it seems like. So yeah, there's a lot there pointing the direction that things are just going to continue the way they are right now. So.
Well, thank you. And I want to thank not just our esteemed panelists today, but all of you who've joined, I think, to listen and participate with questions and so on and so forth. What you're seeing are a few QR codes in this day of QR codes and technology, and they'll allow you to access some more data and insights around this topic as well as some others. So feel free to, I think, capture these QR codes and use them. I invite you to do so. And let's just close with one final question, and maybe, Hillary, I'll pose this to you. I love how you summarize the implications, really, of not just the trends, but new rules. Participate, be thoughtful, and think about the operational implications, and you likely have to ramp up. But I'd like you to really talk about, briefly rather, what really are both the real as well as social implications of not participating.
Sure.
And I ask that because the data you pointed to shows that we have some risk in folks really not participating. But maybe just comment briefly, if you would, on the real risks of that kind of reality continuing.
Sure. The real risks on a loan by loan basis are that the losses are going to be borne by the creditors. The many of your home loans have investors and servicers servicing them, which means that if there's a loss on it while it's with that servicer, the servicer bears that loss, and so the failure to respond can affect that and cause, in some cases, quite significant losses on a per loan basis. So the importance of participating and responding and doing the best you can are very important on an individual loan level. On a portfolio wide level, across a spectrum of cases, the need to participate is significant. If you miss one, most of the courts you're going to get popped on that single case, but it's not going to have an implication that translates to maybe the rest of your operation. Whereas failure to participate on a systemic level now carries with it the possibility of significant sanctions, monetary sanctions, that can, over and above reputational risk, over and above setting yourself up as a as an example of what not to do in the bankruptcy world, has its own level of pain that will bring to you. But the financial sanctions that can be brought, part of the rule was to allow the courts, the judges, to put monetary sanctions on you for failing to participate. So it's no longer I'm going to take my ball and go home. They can reach into your house and grab you by your ear. So don't do that. Participate.
Well, on that note, I hope you all have really enjoyed the the comments and insights from Hillary and from Ryan today. We appreciate you joining us. And again, for Hillary and Ryan, thank you so much for your insights. Please reach out, whether it's through a QR code or other means, if we can be of any further assistance. Really want to ensure that the information and necessary support is there for all of you. So thank you and good day.